Okay, so the first question comes from Jude, and he wants to know, sometimes you see I start with 500 at the top of the chart, and again in another chart, I can see the zero level too. What criteria do you use in picking the figures? So I don't use a criteria to pick the figures, and there is no way to see which IPL is better than the previous IPL. So the reason we have the IPLs, like I previously discussed, is we are trading price action. So the IPLs that are applicable are where price is currently trading. So we wouldn't go and add price IPL levels at the top over here for now because they are irrelevant. So whatever institutional price level here is a round number over here. So for now, that price level is irrelevant unless we are looking to sell in a zone where this liquidity void is placed. So if price comes in and trades to this zone, we will pick ourselves a institutional price level of that zone of price. So when price comes into these areas and when we have additional confirmation, or reasons to take a trade, this will be one of them. So here is a institutional price level over here. And when price came into this order block over here that was created, there was a further move to the downside because there was a large amount of orders sitting at this zone. So if we mark up this order block over here, we can see that this, let's just make it red, this order block sitting over here, this order block was created and was responsible for this move to the downside. Then when price traded back up from this zone at the bottom, it traded into this order block over here, this bearish order block that was created by this large move to the downside. It traded into this order block, and because there was a large amount of sell orders, sell volume, selling pressure, whatever you want to call it, the institutions have orders here and they are just adding more orders so that they can sell again. And that is why this price action over here occurred. So I would have put an institutional round number price level at this zone over here because we have an order block, and I will mark up additional price IPLs at this area of price because this is where price is currently trading at. So I will choose IPLs around this order block, above, in between, and possibly below. And when price comes into this area, I want to see reaction off of my IPLs. Now, I'm not hand picking the IPLs, I'm just using the IPLs of where price is currently trading at. So you can see here that we have this order block formed at our round number of 1.36 USD CAD price, and price fell from that level, retraced back up, tested this order block, and wicked off of our 200 IPL price level. So in essence, you can use IPL price levels if you see that price will come into the zone of where you want to buy or sell. So in this case, you would want to have sold because there was a bearish order block, a liquidity void, so there was large selling pressure over here. And fair enough, price came back into this zone and wicked off of our 200 IPL. So if we look at a 1 hour chart, because we do a analysis from a higher time frame down to our lower time frame, we can see that price came in, and when the 4 hour order block was tested, there are obviously lower time frame order blocks in addition to the higher time frame order blocks. So that gives us additional confirmation. I'm not just adding these price levels for to be random. I'm adding them because this is where price will react from the order block of the 4 hour and above the order block on the 4 hour. So the round number and the 200 IPL. This could have very well been a 1.36200 and this could have been 1.36500. It depends on what price level price is coming to trade at. So if we look at the 4 hour chart, let's just clean this up over here. And we look why price came to the level that it did on Friday. So if we look, this over here is a strong bullish order block over here. So when price came into this order block, price bounced off of this order block, and also there was short-term liquidity sitting below these lows over here. So there was a reason for price to come and sweep below there to take out the buyers that were in the long position from this move to the upside. So this was a large move to the upside, fairly 1, 2, 3, 4, 5, 6, 7. So 7 4-hour candles, and there was obviously a large liquidity pool sitting over here in the midterm, and price came down and filled out this liquidity. So there is a reason for price to have come there. And if we go down to a lower time frame, we can see obviously more action over here. So at this area, there is fair value that has not been closed yet on the 1 hour chart. And that is the reason for price coming into the zone that it did. And if we now go and add an IPL at our 4 hour order block, we will see that this IPL over here exists of the round number 1.35 round number. So if we drag price across here, we can see that the IPL was respected. So not only on the 4 hour chart do we have an order block, we have an IPL at these levels. So before price gets to this level of this order block, we not only mark up the order block, we mark up fair value, liquidity points, lower time frame order blocks, lower time frame fair value gaps, liquidity voids, or whatever is present. And then we attach to our markup that we've done where price levels, IPL levels, occur inside of this strong order block here. So we could have marked up another IPL over here, which would have given us the 200 IPL. So when price initially came down, it just tapped the 200 IPL. The algorithm protected this IPL and price bounced off of this IPL. Again, price came up, tested not only order blocks, but also IPL levels over here. So this is an IPL level over here of 1.36, and like I said, it tapped the 1.36200 IPL level over here. So you mark up on your chart your order blocks, your fair value gaps, or whatever other concepts I'm teaching in addition, and you mark up or add the IPLs of where price action will occur. Okay, so hopefully that answers Jude's question. I'm just going to see if there's any other questions here. Someone asked me, how do I know when an order block is traded through? So when an order block is traded through, we basically know that when we mark up an order block, so let's just see here, let's just use this order block over here as an example. So this is a bearish order block over here, and when it is traded through, you need to see candle body closes above or below a order block for it to remain a violated order block. If it just wicks through but does not close above or below the order block is still valid. So price can violently wick through. Let's just take this wick as an example, like that. And if price still closed below, then that order block is still valid because price did not close above the order block. So it needs to close above the order block for it to remain valid. And the same would apply if it is a bullish order block. So if we look over here, this is a bullish order block over here, and we can see price traded through that order block. So it was violated. Okay. So this is how you identify violated versus consistent order blocks. Okay, so hopefully that answers his question. Abhishek, you've got a question. Go ahead. Abhishek? No question? Okay, so
Can I ask?
yes, you can. Go ahead.
I was asking, how do you identify a strong pair and a weak pair?
Okay, so let's look at a chart. Do you have a specific currency or whatever we're looking at? Do you have something we can work with? Anything particular? Or what do you like to trade?
You can try GPU.
GU, okay.
GU. Yeah.
Okay, so GU, right? So the same as what applies, I don't know if you've watched all the videos already, but to determine currency strength, you basically can follow the order flow of the chart on a higher time frame, which will give you a stronger directional bias as to where price can go to. So what do I mean by this? Okay, well, if we had followed the order flow from this zone over here, we can see that price is heading down. Okay, so obviously price is bearish over here, and this order block over here, this one here, was the last bearish order block before price rallied above this level over here. Okay, so what do? We pull this order block across over here, and we can see that when price trades through this bearish order block, so this is a bearish order block, and we expect price to go down based on it being a bearish order block. So when price goes down, we want to continue seeing a downtrend, and when price closes above with a closing candle, this becomes a breaker. So we are looking for buys now because price has closed above there. And the same would apply on a low time frame because we are looking at a daily time frame. So these moves happen slower, but you can see once price closed above here, although there was a move continuously from this downside over here, price continued to rally for at least 350 pips. Okay, so when price comes back into this zone over here, and obviously we also know that we mark up a source at the bottom, so the lowest down candle. Okay, so we mark that up as blue, and this being yellow because it is now a breaker. So price will test the breaker and sometimes even test the source. But when we see an order block, so here is an order block, a bearish candle that was traded through becomes the order block. Okay, so sure, there's other order blocks over here, but this was the last bullish order block before price started to retrace back down. So there's no other bullish order blocks over here, or there's no other bearish candles even. So this is what we use for price to test. And when price came there, it tested our breaker and bounced first, as we can see over here. Price bounced, tested this order block over here, and retraced back down. When it retraced back down, where did it retrace back into? Well, this is a 50% of a daily order block that was barely tested. So when I say barely, I don't mean bearish. I mean it was tested very briefly. It only tapped it. So the more price tests, whether it's a specific price level or an order block, the more chance it will have to break that level. So if we see that price continuously comes in, rallies off, comes in, rallies off, this is obviously creating a point of liquidity, and price will eventually come and break below the lows that price had bounced off of, because not only is it now an order block, it's also retail support. So you can think of the amount of liquidity that is sitting below these levels over here. So that will be raided. But because this order block was the last order block before price rallied, it came in, tested it, and bounced again. So when you are wanting to know the strength of a currency, mark up your chart, find yourself a source, find yourself a breaker, mark up a few daily order blocks, and you will see significant difference in your trades if you can use the higher time frames. Because if you are using a higher time frame, you will see larger moves to the downside. So this is obviously GU. And when price came into a specific level, so this is an example as well. This was a breaker because this was the last bullish order block before this moved to the upside. So when price traded through this bullish order block, it becomes our breaker. So when price comes back into this area, we can expect a reaction. And lo and behold, when price came into our breaker over here, we can see that price retraced down. So we have a source candle at the top over here. So this would be our source for the top, and this would be the source for the bottom, this large candle over here. So we can trade from source to source on a daily chart. But when you see other confluence, you can take trades based on a higher time frame. So this, if you follow the order flow and you follow my previous YouTube teachings, you'll understand what I'm showing you here. And this can give you the directional bias of a currency pair. I don't believe in currency strength because news events is indicating that it's going to be stronger, or other indicators or websites telling you that the index of strength for euro or GBP or whatever currency pair is 7 out of 10 and it's stronger. That number is going to change throughout the day. It is based on order flow and how the banks are taking price to where they are taking it to. We don't know specifically where price will go to, but we sure can be accurate with an 80% certainty that price can come to the levels we have marked up on our chart. So if we mark up a higher time frame and we look at this bullish order block, for example, over here. So let's just clear this chart up again, and here is a bullish order block. Okay, so we've marked up this bullish order block over here. So there is a bullish order block over here. This candle over here was black bearish, and this candle traded through violently. So this becomes an order block, and you can see it was responsible for a large move to the upside. So because price had not come back to this order block and tested it, or price has not returned there, we can expect reaction off the zone. So this gives us strength based on a higher time frame of where orders are laying for institutions, hedge funds, banks, whoever, for a reactionary zone. So if we look, now we pull our 4-hour chart to that daily zone. So this is a daily order block. Let's just make this one blue. And when price now, this is a 4-hour chart. So if we look on the 4-hour chart, we can identify additional order blocks, additional confluence for when price comes into the daily order block we want to buy. So we can mark up here that this is a 4-hour order block over here. So this candle over here, okay, we can see it's in line with the doji candle. So this order block here and this doji candle over here, forget this wick, that's probably just a run on liquidity, like I said, candle bodies. So when this order block was created, we can additionally see that other confluence takes us into a trade. So here is a fair value gap that was created on the 4-hour chart. So when price rallied from this daily order block at the bottom, there was a large move to the upside. So when a large move to the upside happens, we want to see price come in so that the institutions can add additional entries or sell or buy at a lower price. So in this example, they pushed price up, so they will want to push price up again, but they will not do that at the current market price. They will wait for price to come down or even sell from the top and buy from the bottom because they are buying at discount. So for example, pull our fibs from body to body, and we can see that although we did not get an entry over here, price filled this fair value gap over here, and then price continued up because there was an imbalance of price. So this gives us confidence that this move now has finished because it also tapped this 4-hour order block over here. So not only do we have a daily order block, we have a fair value gap, we have a 4-hour order block. And although this fibs that I have pulled here does not indicate to us that the 79% has been respected exactly, we have other confirmation. So when I see some people taking trades only using fibs, it sort of annoys me because based on the fact that fibs is not to be taken lightly. You cannot just take a trade based only on fibs. You need to have other confluence. And this is an example of that. So fibs does not always give us our 79%, but we can see that price traded above and closed this fair value gap. So we used here the higher time frame to decide for us that price was going to remain bullish from this order block over here. So the same can be said in reverse. So if we clean this chart up and we look at the top over here, this is a strong bearish order block. So when price trades into a strong bearish order block, we can expect a sell again. And sure enough, that is exactly what happened. So we know that this is a daily order block, a bearish daily order block. So if we go to a lower time frame, the currency strength was bullish from our previous bullish order block until the daily chart created a daily bearish order block. So when it creates a daily order block, you can go the next day and look for sells, because if the order block is created, you can go and look for a sell. So you would go down to a lower time frame and frame yourself up an entry to sell from this order block over here. So this was a daily order block, and this was the price created over here. And sure enough, when price came back in, we could have sold, and we see that there is reason to sell at these gaps over here. There is a large imbalance of price over here on the 4-hour. So if we had taken a trade, it could have been a good trade. And that gives us the currency strength based on the order block, because we are trading institutional concepts, not news, not indicators, nothing like that. We are trading where the orders of the chart for the banks or the institutions are placed, and that is how we find our currency strength. We use higher time frames to decide where price will react from. A strong reaction on a higher time frame means a bullish or a bearish order block. So just like when price for GU came into this bullish order block over here, the same reaction applied. So the currency strength for GU from the day that this order block was created was bullish, okay? And when price retraced back into this daily order block, price again was bullish. So if, for example, price comes into this daily order block again, we can expect it to be bullish again. But whether or not it's 100 pips or 1,000 pips, that is for the market makers to decide. We take our profits when we see it. We have certain levels of targets of profit that we want to achieve. We are not greedy. We take what we get out of the market. We are not market makers. So we need to trade in accordance with our trading plan. And that's something I can touch on later time. But this is currency strength in a nutshell. Where the higher time frame orders are placed is where currency strength will exist and where it will lie. So again, if you go to a higher time frame, here is an order block, this large order block over here. So when this was tapped by this wick over here, there was a large reaction to the downside. And that is because this is a higher time frame order block. And the same can be said when this top over here was created, when price came into the 50% level of that weekly order block, price was bearish. Okay, so that gives us currency strength as we know it, as trading in line with institutional concepts. This is our currency strength. Higher time frames gives us currency strength. Okay, so hopefully that answers your question. Benson, you got a question? Go ahead.
Okay, good evening, Darren.
Yes, I can hear you. Go ahead.
Okay. Sorry, please. Can we get down to NZD card? There's something I wanna.
AUD CAD.
No, NZD card.
Okay. Yeah, sure.
Okay, can you get down? Can you get down to weekly?
Yeah, this is a weekly chart.
Okay. Okay. At the moment, I know we're not using trend line, but then can you say from now that price has respected taking out some liquidity pool above there, and can we expect a bearish move in NZD?
Are you talking about these recent highs over here?
Exactly.
Okay, so yes, so this was recent highs that were taken. Okay, as you can see here, that if you probably go down to a low time frame, once these highs were raided, there was a small reaction to the downside. Okay, so it is not set in stone, or there's no rule to say that once liquidity is raided, that there will be a large move to the downside. Often, liquidity pools can either be targets if you are buying or reasons to sell. So let's use some examples over here. So this is a pool of liquidity on this high over here. And as you can see, when we looked at EU this week, it raided liquidity and then fell from that position down once it had raided liquidity. But in this example, there is liquidity there, and we can see on the weekly chart that price is continuing to go higher. So let's just look at the daily chart, and you can see that once that liquidity was raided, there was a small move to the downside over here, which is not much. I mean, on NZD CAD, that's only 50 pips. So that is not a large move to the downside, okay? And when that liquidity pool was raided, it basically traded into this order block over here. So these two black candles in themselves is an order block, okay, because they were traded through. So these black candles are an order block. So when this liquidity on the weekly chart over here was raided on the 4-hour, you can see. So this red line indicates the run on liquidity. And then when price retraced back down, it only just retraced into this order block over here, this 4-hour order block, and then bounced. So this was probably the 50% level of that order block, and then price rallied again. Then if you're still not convinced that price is going to fall once liquidity has been raided, there is obviously an additional plan the market makers are formulating. So maybe there's other liquidity, and as we can see, this liquidity also here above this weekly high was also run out over here, okay? So it is very likely that there is a gap here of price. So there is a gap there on the weekly chart. So there is large price imbalance on this weekly chart over here. We can see there that there's no intersecting wicks or candles, and there's a big gap over there. And let's go see on the daily chart what is happening at that zone. So we can see on the daily chart that although the weekly chart represents to us that there's a large void in price, the 50% of this gap has been filled on the daily chart, okay? But obviously there's other targets for price that is wanting to go up. So like I said previously, that the order blocks on higher time frames indicate to us currency strength. The same rule can be applied to this specific example as well. So this is a weekly chart. So if you were to follow the order blocks being created on this chart, you will see that they are basically being respected, and price is just trading in an upward move. So if you were to mark up these order blocks on the weekly chart, so let's just do that. And because this is a weekly chart, price will continue to go higher, and until it meets a other criteria of where price wants to retrace from, it will just continue. So as an example here, this is an order block that was recently created on the weekly chart, sorry. And if we go down to a daily order block, you can see that this order block on the weekly was basically a daily accumulation of a weekly period of where price was trading in, and then obviously there was a breakout. So this indicates to us that currency strength is bullish because there is an order block created on the weekly, and we can see that other bullish order blocks on the lower time frames, like this one over here, was respected. Then there was this one created and responsible for this large move to the upside. So the weekly, the daily is currently bullish on NZD CAD. So to think to sell at a specific point to catch 1,000 pips wouldn't be advisable. You would rather want to look for buys on a higher time frame and then use the lower time frames to decide of where price can potentially start to retrace from. But you need to know the higher time frames, what they are telling you. So like we've marked up here, that this area on the weekly chart is an imbalance, and we can also see on the daily chart there's imbalance. And now let's just, for the sake of looking at higher time frames, see that this is a order block on the monthly chart over here. So we also know that there might be a chance on the weekly and the daily that those imbalances are filled, but we can see reaction off of this monthly order block right now. So it's a very small reaction. So if we measure that, it's about 22 pips, but that is the initial reaction we are seeing off of this monthly order block. So the weekly indicates to us price can potentially continue higher over here. Do you have any further questions regarding that, Benson?
Okay. Oh, thank you for that. And that was that was clear enough. Another question I just want to ask is, based on instrument in general. Some some actually do have peace. Like the number of peace doesn't correspond with the value of the dollar value. I would say. For instance, let's talk about Euro USD or most of these USD or GU or maybe yeah, other pairs. When they have something like 10 piece, that they're
Yes,
doing a
I
deal.
understand what you mean. So some currency pairs have different dollar value per pip than other pairs, but generally the rule
Yeah, exactly.
is that for every 0.01, it generally represents 10 cents a pip on the chart. Now,
Yeah.
there is a website I can send you to where you can be specific to this, and it tells you exactly of where price will go and how much its value is. And I'll send you this link. It's my FX book, and it will tell you all the currencies value per pip, because some of them are different, like you've noticed. And this will tell you which currency pair, which commodity is the value of the pip per the amount of pip you've put. So if you put a 0.10 or a 1 lot or a 10 lot, whatever, it will tell you the value of the pip on the currency pair that you are using. But hopefully that will help you. I'll send a link in the group for you.
Okay, thank you. But actually, why? I mean, is it being said by the broker or is just being done by the algorithm or the market makers? Why is it like that? Why are they deciding the value of in the dollar piece?
That is
Uh,
that is not something that the algorithm itself controls, but more of a government and regulatory body that they implement. So all brokers, whether they're regulated or not, the currency of a country is where the pip value comes from. So South Africa is the ZAR, and they are obviously trading, say, USD ZAR. So their pip value will always be the same, but it may not be the same as Euro USD. So maybe one pip represents 8 cents, and Euro USD one pip represents 12 cents, for example. And that is not something that
so
anyone just creates. It is South Africa and the USD, so it is different. So no one, the country decides that, the South Africa or the United States or whoever the case is. Hope you sent that
so
question about the order block. Yes, it is wick to wick of the candle is the order block, and the body is obviously where the meat of price action occurs, but generally the wick to the wick is where we measure order